Hi, this is David Daughtry at Copperwind Financial. This is the first of a series of educational talks that we're going to be providing to anybody that has interest in them over various topics over the next 6 to 18 months, probably once a month or once a quarter, or when a topic comes up that we think is interesting. If you would like to have a topic addressed, please feel free to give us a call or email us. But they're going to be fairly short, one subject at a time, 10 minutes or less, and only hitting on the high points. And I'll try and make it as user-friendly as possible and eliminate as much economic speak and market speak as I can, because we want these to be ones that are helpful for your knowledge and information. So today we'll get started. The topic that we're talking about today is going to be, and let me get going here, why are interest rates going down instead of, as expected, going up? And I'm going to provide you some logical reasons why they should be going up and some reasons why they're probably not, and then wrap that into some potential outcomes and conclusions at the end of this talk. So when we look at why interest rates are going down, first off, we'll look and say, let's look in December 2013. It was nearly unanimous in December 2013 as people put forth their 2014 outlooks that certain things were going to occur, and it bothered me at the time, and we talked to a lot of our clients about it at the time, that everybody was saying the same thing. And in a market, if everybody thinks one thing is going to occur, it nearly never does, because everybody's on the same side of that trade. But what everybody was saying is that stocks will continue to do great. We had just finished one of the best years that we had in over a decade, and everybody said you got to be in stocks. The treasury yields were going to go up. They had no place to go but up, and so that the logical thing to do would be to sell bonds and to buy stocks. Well, a funny thing happened on the way to the forum in that that's not been what has occurred very well this year. People that sold bonds and thought that they were going to go up in yield have been disappointed. Those that held on to bonds have done quite well. Stocks for most of the year have not done well, but recently in the last month have come back, and stocks and bonds are about the same place right now. So when we look at that, didn't quite work the same way. Now let's look at some of the reasons they thought rates should rise. One is that the Federal Reserve is buying fewer bonds. They're tapering. The quantitative easing, they're tapering off. So over the last 6 years, they bought about $5 trillion by the end of this year, about $5 trillion worth of mortgage-backed securities and U.S. Treasuries, and they paid for it by printing money electronically out of thin air. So if the biggest buyer of bonds leaves, then prices of bonds go down, and when prices of bonds go down, yields go up. There's an inverse relationship between the price of a bond and its yield. The economy is improving, so more demand for credit, and the price of credit is the interest rate. So if there's more demand, then the price goes up, the interest rate goes up. And foreign governments were buying fewer U.S. Treasuries. Japan and China, the two largest central banks that are buying U.S. Treasuries, each one of them own nearly $1 trillion worth of U.S. Treasuries. Over the last year, they have not sold their Treasuries, but they're not buying any new ones. They're sort of keeping a static amount of about $1 trillion. So people were saying if the foreign governments are buying fewer Treasuries, then rates have to go up, or you have to have rates go up to entice more buying of these Treasuries. And they were saying it's the end of a 30-year bull market in bonds. And this is a chart that goes back into the 1960s. Fred is not the guy that does our charts. It's the Federal Reserve Economic Database, and that's where we get a lot of our data. And what you see here is back in 1981, when Paul Volcker was the chairman of the Fed, he said we've got to stop inflation, and I will squeeze it out by raising rates to very, very high levels, and he was successful. But the 10-year went to over 15%, mortgages were 16%, prime rate went to 21%. Not a fun time if you owed money. But over the subsequent 30 years, what you saw is a decline in rates. Now, there were times like in 93, 94 when rates jumped about 2% at one point. But over that time frame, rates continued to go down until really bottoming out in 2012. And then everybody said, oh, now what we're seeing is 2013, this is May of 2013, 10-year went from about 1.7% all the way up to 3% in a very short period of time. If you owned long-dated long maturity bonds, you got hurt a lot. A 20-year bond lost nearly 20% in value during that time frame. So people were looking and saying, well, you know, that's if we look back, we think rates are going to get back to the historical 5 or 6%, which you see in here, and you say, yeah, that's sort of an average there. But then, if you look on a longer-term basis, this is the U.S. Treasury's 10-year going back to 1871. Then it's a little bit different when you say, what's the normal rate for the 10-year? It's really between 2 and 4% for nearly 90 years during that time frame. So this may be more of an anomaly. And so when you say it's going to get back to normal rates, well, what are normal rates? They may not be 5 or 6%. So when we look at that, you've got to be a little bit more concerned from that standpoint. So if we look at the other thing that we'll get into is the relative value. And let me show you when we're talking about rates rising and what sort of offsets the why interest rates should rise. The Federal Reserve is buying fewer bonds, they're tapering. Well, also when you look at that, the Treasury was issuing basically $1 trillion of new Treasury bonds every year for about 4 years. But last year, that dropped down to about $680 billion. This year, it's probably going to be $500 to $600 billion. So the Federal Reserve, yes, is buying fewer bonds, but there's fewer bonds being issued, so you don't need it as big a buyer. So that will, the tapering will be muted somewhat by that. The economy is improving. But for the last 3 years, the Federal Reserve has said every year the economy is probably going to grow by about 3%. Well, in the first quarter, it didn't grow. It was minus 1%. So to get to their 3% number, you would have to have basically 3 quarters in a row of 4.3% growth. That's not going to happen. We might hit 3.5 to 4% this quarter as we catch up from some of the delayed spending that occurred that we missed out in the first quarter. But the economy is not improving near as well as they thought. And foreign governments are buying fewer treasuries. Yes, they are. But there are other players out there that are buying more, and I'll tell you where that's coming from. A lot of the pension plans, defined benefit plans, state pension plans, those types of things, last year they became very much overweighted on stocks because stocks went up 30%. If you're 50-50 allocation between stocks and bonds go down by 2% like they did last year, and stocks go up by 30% like they did last year, then you've got too many stocks. What do you have to do? You have to rebalance. That means selling stocks, buying bonds. So you've got some of these entities that are doing that. The other thing is the insurance companies. Life insurance companies have 48% of their assets in long-dated bonds. And so they're going to be doing the same thing, buying bonds, selling stocks. So some of the things that offset that. The other is relative value, and that's where we look at Europe. And this is looking at global 5-year rates, government bonds across Europe. So if you look at Switzerland, the 5-year government bond is 0.11%, which compared to the U.S. at 1.49%, you know, is Switzerland better than us? And they're probably not going to get into a war since they're neutral. Their economy is doing pretty well, but should they have a rate that's 93% below what ours is? Probably not. Germany, they're at 0.41. Probably doing a little bit better from a unemployment rate. They're about 5% versus our 6.5%. But should they be at 30% of our rate? Let's look at somebody like Slovakia, that economic behemoth of Europe. They're at half our rate. Ireland, that 3 years ago was about bankrupt, they're still at 1.22%. So if I'm a natural buyer of European government debt, I'm looking at these rates, I probably look to buy in the U.S. So that's another buyer from a relative value basis. Let's look at the 10-year, and this is, I call it the lunacy of rates. The Spanish 10-year rates 2 years ago were at 7.5%. They're now below 3%, and they have 25% unemployment. You look at Irish bonds. In 2011, they were at 14%, and they're where ours are, 2.58%. When you look at it from a relative value basis, I think you're going to see more of people that would have bought European bonds buying the U.S. And it's even worse in Japan. Japan's 10-year is 0.6%. So the conclusions, what do we come up with here? Well, we think that rates are probably for the rest of the year going to be in the 2 to 3% range. Things slow down, they go down to 2%. Things pick up, they probably go to 3%. Or if we had something like a Ukrainian thing spin out of control, they might go to 2%. Federal Reserve might delay tapering if the economy stumbles or doesn't continue to improve like they think it will be. And the European rate decline will probably keep rates low. Mario Draghi, he's the Ben Bernanke of Europe on the European Central Bank, and he has started printing money. They announced that this week. So probably will keep rates low, which probably means that bonds are not going to get hurt like people thought they would. We don't recommend you buy a bunch of long-term bonds unless you've got a strategy that will get you out of harm's way when they get hit. That's why we use models in all of our income strategies. So that's the end of Dave's talk. I appreciate you listening to this. If you have any questions, feel free to give us a call.